Assalamualaikum warahmatullahi wabarakatuh. Guys, we are back to look at one more interesting issue in the banking industry. And that would be the question, are the banks, namely conventional bank and Islamic bank, are the banks making too much profit? So this is the question. This is very important because we can see that profit come from the loan the bank gave, or the murabaha that the bank gave away in Islamic banking. And but the loan rate or the murabaha rate set by these banks are not based on the deposit rate, meaning that the CASA rate, current account rate, which is 0%, and then saving account rate, which is usually lower than 1%, and the fixed deposit rate are also lower than 3%. So instead of using the deposit rate, the banks are using the OPR, or the overnight policy rate, as the base rate in the setting of the loan rate or the murabaha rate. And these are required by the Bank Negara Malaysia as gazetted in the reference rate framework 2021. And for this reason, we would like to see what will be the impact of using this OPR as the standardized base rate instead of the deposit rate as the standardized deposit rate as the cost of fund. As we know that the loan rate or the murabaha rate are comprised of the cost of fund and the spread, right? So there are two components of the loan rate or the murabaha rate or the profit rate. One is the cost of fund component, and the other one will be the spread component that will consist of a number of factors, where the credit spread is the most dominating factor in the setting of loan rate or the murabaha rate. But before going into those pertinent issues, let us just look back at the nature of the banking business, whether it is conventional bank or Islamic bank. And I have been echoing this issue many times in my previous videos, that when the bank make a loan, they are not using the capital fund to make the loan, but they are using the deposit funds. And likewise, the Islamic bank themselves, they don't use their capital fund to make the murabaha. They are using the deposit funds. And deposit funds, as we know, are leverage funds or borrowed funds that the bank acquire from the depositors, and by which this borrowed fund, by way of the interest-bearing contract or the riba contract in the conventional deposit. So these borrowed funds or deposit funds usually give low interest rate, as the interest-based deposit contract, which is riba, are fully guaranteed from loss. Likewise, the so-called tawarruk deposit contract are also fully guaranteed from loss based on the way how the tawarruk deposit was structured to ensure that the tawarruk depositor will be getting back their total placement plus profit at maturity. So in a sense that these borrowed funds are used by the bank to make loans, interest-bearing loan for conventional bank, and for Islamic bank, it is the use of tawarruk deposit to make loans, to make murabaha financing. So it is very clear by now that both Islamic bank and conventional bank uses leverage funds or borrowed funds to make murabaha and loans respectively, and they are not using the equity fund to make loans. And these equity funds are actually utilized by the bank to support the loans or the murabaha that the bank gave away. And as we know that the role of this equity capital is to absorb any loss coming from these loans and murabaha, right? So the role of equity capital is to support loans against default, which is to absorb any loss when there is a default event occurring. For that matter, when the bank uses leverage funds to make loans and to make murabaha, so meaning that the banks are not using their own money to make the loans and murabaha in conventional bank and Islamic bank respectively. So the regulators require banks to hold at least 10.5% of their capital against all loans and murabaha. So I'm using loans and murabaha interchangeably because we are referring to both conventional bank and Islamic bank in a dual banking system. So please bear with me when we are, using these terms, interchangeably. So what will happen here is that when the bank are required to hold capital against the loan they are making, and the amount of capital they must hold will be at least 10.5% of their capital holding. So it means that if the loans the bank is making is 100 billion, if the murabaha the bank is issuing is 100 billion, then the bank must hold a minimum of 10.5 billion against the 100 billion worth of loans and murabaha. All right, so this is how bank capital is utilized in the banking business. They are not used to make loans, but they are used to support the loans or murabaha that the bank is currently holding. So technically, so when the regulator require the bank to hold 10.5% of their capital against any exposure, any loan exposure, technically it means that if the 100 billion loans fall into default, then the depositor can claim only up to 10.5 billion from the bank, from banking capital, meaning that the equity capital of 10.5 billion is available for the customer to claim when the entire loan or murabaha get into trouble or get into default, right? So the remaining balance of 89.5 billion can never be recovered because the bank has only 10.5 billion to pay the depositors. So this remaining balance, huge amount, can never be claimed by the depositor except through litigation. And when the bank falls into bankruptcy or when it becomes insolvent, then there is a chance the depositor to recover the balance, the 89.5 billion balance, from the deposit insurance scheme, such as in Malaysia, we have the PIDM, and in the USA, we have the FDIC. So this is, the so-called the polemics of the banking industry, where they are not using their own money to make the loan or to make the murabaha. they are using leverage money or they are using debt money acquired from the depositor. And the role of the bank capital is to absorb any losses that can occur based from the exposure of 100 billion. Of course, when the bank issue 100 billion worth of loans or murabaha, we assume that there is a robust risk management process that the bank have observed, and these 100 billion loans or in murabaha are good loans, but there is a possibility that some of these loans can get into trouble, and this is where bank capital will come in to absorb the losses. Maybe let's say 10% of the loan may fall into trouble. So 10% meaning that 10.5 billion or 10 billion in default. So the loss from this default can be covered by the bank, since the bank have already basically secure sum of 10.5 billion from bank capital to absorb any what we call extraordinary losses or any unexpected losses, coming from the loan or murabaha exposure. Okay, guys, I think we can stop here, and then we'll continue again in the coming videos. I see you again. Thank you very much. Assalamualaikum warahmatullah.